Hello everyone and welcome to today's session. So today we are going to continue our chapter number 14 and that unit 2 in chapter number 14. Okay. So what we discussed in last session, quick recap. I'll take a quick recap of what we have discussed in the last session. In the last session, we discussed about various acts that are applicable to the NBFC. Okay, when it comes to the NBFC, various acts that are applicable, how NBFCs are, critical when it comes to the audit. Okay, why we say NBFC is a critical, entity when it comes to the audit. Then we discussed about, various types of NBFCs, like various type of NBFC. That means when I say different types of NBFCs, it is based on categorization, it is based on scale based. Then we discussed the RBI Act, Section 45 IA. We discussed Section 45 IA of the RBI Act, where we discussed about the net own funds. We also discussed about the definition of NBFC under Section 45. Okay, under Section 45 I, subsection A, where we discussed about the definition of the NBFC. Okay, we discussed about how to calculate own funds with respect to NBFC, like what is the formula to calculate own funds. And then we basically went to discuss on the structure of the NBFC or the categorization of the NBFC between various layers, like base layer, middle layer, upper layer, okay, and the top layer. Like this was the scale based layering that was there as per the scale based regulations. Now, apart from that, we have other types of categorization which is based on the activity or kind of function they are following. For example, activity with respect to ICC, CIC, IFC. So various different type of NBFCs are there, and there are different type of categorization available with respect to that activity of the NBFC. Okay. Now, as I told you that NBFCs were earlier of two types: one deposit accepting, another was non-deposit accepting. Now it has changed to the scale-based regulations. Plus, we discussed there are certain kind of NBFCs which are already exempt from the registrations requirement under RBI Act. Reason because they are either governed by some different act or regulation, or they are specifically falling under some other regulatory authority apart from RBI. For example, housing finance, they fall under the category of or under the purview of National Housing Bank. Stock exchanges, because these are primarily governed by the Security Section Board of India. So there are certain NBFCs, again, they are dealing into, they are falling under the definition of Section 45I, and they are also, eligible to be called as an NBFC, but still they are exempt from getting themselves registered under Section 45 IA of RBI Act. So each and every NBFC which is falling under the definition of NBFC as per Section 45I, or it is having the 50-50 ratio, is required to get themselves registered under Section 45IA of RBI Act. Otherwise, they are not allowed to carry on the business of NBFC. Okay, and but these are the exceptions, you can say, or the exemptions from the registration with the RBI. After discussing, we discussed about the scale-based regulation. We discussed what is the basically scale-based regulations, why it is important to understand scale-based regulations, like what is base layer, what is middle layer, what is upper layer, top layer, which NBFCs fall under which particular category. For example, we discussed that, okay, NBFCs which are not accepting deposit, having asset size less than 1000 CR, okay, fall under the category of base layer. If their asset size is more or they are deposit accepting, it will go to middle layer. Okay. Then we discussed about what is upper layer based on the scoring methodology. So there will be some scoring, and on the basis of that, we will select the NBFCs which will fall under the upper layer. Top layer remains usually empty, but when there is an increase in the risk, okay, systemic risk in that case, or the failure risk in that case, RBI may choose by notification transfer some or that particular NBFC from the upper layer to the top layer. Okay, so top layer remain usually ID, remain empty, but based on the risk, NBFCs can be transferred from top layer or from upper layer to top layer. Okay, so that is how the layering system works. Now, as we discussed, that the layer decides what regulations will be applicable in which way to that particular NBFC. Okay, so we discussed that what regulations will be applicable to which NBFC in which particular way. Okay, so that was we discussed basically in the last session. Any doubts with respect to that? Any doubts? See, I would like everyone to ask questions or discuss their doubts, because then only you guys will be able to understand the topic in detail. Okay, so do not hesitate to ask the doubts. Okay.
Excuse me, sir.
Yes.
Sir, in earlier lecture, you have told about that gliding path.
Yes.
I think that gliding path is, है ना, वही था ना word?
Yes. Yes. The glide path.
Glide path.
Yes, this
तो
glide paths
उसको
was there in the last lecture.
yes,
Yes.
उसको एक बार आप वापस से समझा देंगे, यानी कैसे, यानी ग्रेजुअली मैं समझ नहीं पाई, यानी एक टाइम पे तो इतना होगा ही ना अमाउंट बिजनेस का, तो ये
Okay.
ग्लाइडिंग पाथ, सॉरी ग्लाइड पाथ क्या, यानी समझ नहीं पाई मैं.
No issues. See, now what is glide path basically? Now, earlier the requirement for the NBFC to have the net on funds, okay, was 2 CR, and for certain categories it was different. For example, CIC and everyone was having different requirements.
Yes.
But what RBI said is now no, everyone has to maintain, specifically ICC, MFI, and Factor has to maintain 10 CR. But what happens is from 2 CR to the 10 CR, it is not easy. I cannot say, immediately, okay, from next day, now you are required to maintain 10 CR. So they have to, arrange 8 CRs net on fund more. So what RBI said is that, okay, fine, do not do from the very next day. I'll give you a timeline that you need to reach to the 10 CRs net on fund. Remember, we did a calculation for the net on funds formula.
Yes, sir.
Now, in that case, basically, if I say that, okay, on the 31st March, you were supposed to maintain net on funds 2 CR. Fine, you will do calculations, you will, keep your assets in such a way that your net on funds is 2 CR. But suddenly on 1st April, no, I require 10 CR. How will you arrange in a short time additional 8 CR? That's why RBI said, do one thing, don't increase with the, sudden, like, 10 CR. I'll give you a timeline, let's say 2027. By the end of 2027, make it 10 CR. But what you do is you make sure that at the end of 25, you reach to 5 or 7 CR. And then at the end of 27, you reach to 10 CR. So from 2022 to 2027, I am giving you 5 years to increase from 2 CR to 10 CR in a step way.
अगर सर 2025 तक 5 CR नहीं होता है, लेकिन यानी 4 CR जैसा कुछ रहता है, लेकिन 27 तक 10 CR तक वो पहुंच जाता है, तब यानी फिर क्या एक्सेप्ट तो करेगी आरबीआई?
No, they have to. That's why the glide path was given. Like, they have to maintain that much amount in that particular year. It is not like that you have to at the end 20 in 27, if I maintain 10 CR, I'm done. No, at each and every stage which is mentioned in the glide path. For example, on 1st October, this current portion which is there is nothing but your 1st October 2022, when the notification came into place. So RBI said no, on 1st October you maintain this much, 2 CR, 5 CR, 5 CR. But on 2025, make it to 5 CR. So I'm giving you from 2022 to 25's timeline to increase your net on funds by 3 CR more. And they have to comply. we will see, reports where we will see the reference to this particular regulation and how they have increased the net own funds.
Okay, sir.
And now next 2 years, they have been given next 2 years to increase it from 5 CR to 10 CR. This is the gliding path or glide path.
Okay, sir. Yes, sir. Clear. Thank you, sir.
Any other doubts? Any doubts, guys? See, I would recommend everyone to ask doubts as much they can, because then only you guys will able to understand the topic. If no doubts, good. I hope you guys now understood everything. So what I'll do is I'll ask few quick questions and I want the answer to test that, okay, you guys really understand the topic now, so that we can, proceed ahead. A quick quiz type of thing. Okay. Tell me one thing. What is the, particular requirement for the NBFC? So we discussed that, okay, there was some, requirement with respect to financial asset and income from those financial asset to classify a particular NBFC, to say that this particular entity is a NBFC. Can anyone tell me that requirement?
सर बोल के बताना है या चैट में बताना है?
Fine, you can speak. Perfectly fine.
Sir, that requirement was financial asset 50% of total financial asset, and out of that financial asset the income will be generated would be also 50% of total income of the NBFC.
Yes. Very good. Absolutely correct. So if your financial assets, okay, are more than 50% of your total assets, and the income generated from that financial asset is more than 50% of the total income or the gross income, in that case, it will be, that particular entity will be your called an NBFC entity. Okay. Now, second thing is that I want to ask basically, when it comes to the layering scale-based regulation, now which basically, is the first step, or you can say the first layer in the scale-based regulation? Pretty easy. First layer in the scale-based regulation. We discussed about the scale-based regulations and the layers in the regulation. Which is the first one? Very good. Yes, Jenny. Anyone else? Only one answer. I think rest of you either not have visited the chapter again, or you are not aware about the particular topic. Okay. So the first one is the base layer that we discussed. And then we discussed that, okay, middle layer, upper layer, and the top layer. Yes? Okay. So, guys, I would recommend everyone to please read the chapter. That is very, very important. Okay. Now we will start with respect to, few things that, are relevant with respect to the prudential regulations. Okay.
Excuse me, sir.
Yes.
Can you please start with the tier 1 calculation? You have.
I'll come to that. They are part of the this only prudential.
Yes, sir.
Yes. Okay. So we will now discuss the prudential regulations. Now, what are these regulations basically? When I talk about prudential regulations, these are the regulations, or these are the particular norms which define that how a NBFC has to work, which may include your leverage ratio, which includes your capital, tier 1 capital calculations, which includes your accounting standards, So they include a lot of things in that. Okay. And we have to discuss those things in detail. So that along with that, we will also discuss the reporting requirement basically for these particular regulations. Now, for example, a particular section of a prudential norms is how to account for investments. Yes, there is a different accounting for investments when it comes to the accounting of investment for NBFC that is required to be done as per the these regulations. How to recognize income, how to recognize income from stressed asset, how to recognize income from investment, asset classification. A lot of things are there. They all are part of your prudential regulations or prudential norms. That means how an NBFC has to do accounting and operating aspects, how they have to deal into that. So that is the part which we will be discussing. Now, quickly, can anyone tell me whether Indian accounting standards, Ind AS, are applicable to NBFC or not? Okay, okay, Ginny. Quickly, guys, whether Ind AS applicable to NBFC or not? Anyone else? Whether it is the whether Ind AS is applicable to the NBFC or not? No, no answers. Okay. See, this is very important to understand because you have already discussed this particular point at the some other subject also. Now the concept here is it's not something related to the audit whether the Ind AS is applicable or not. It's already being discussed. I think you might have already seen in the FR in the Companies Act with respect to the applicability of the Ind AS to the company. See, at the end, NBFC is what? A company registered under Companies Act. So the rules which are there will be applicable to them, and the rules, whatever in the way that is defined, will be applicable to NBFC also. So in that case, Ind AS is applicable to NBFC. It's not like that it is not applicable to NBFC. It is applicable to NBFC. There has been a particular, you can say, division also. Can anyone tell me what is the division or schedule that is applicable with respect to the financial statement when it comes to the NBFC under Companies Act? So what I'm discussing as of now is the question on the Companies Act. So how NBFC is required to prepare their financial statement? What is the format? Where the format is specified? Okay, Ginny. Anyone else? Anyone? In which format the NBFC is required to prepare their financial statements? Simple, straightforward question. No? Okay. I have only received one answer. Good. It's division 3 of schedule 3. Division 3, yes, division 3. Again, I'm repeating myself. Not division 2, division 3. Now you'll ask, what is division 3? We have heard division 1, division 2. If you go back and check how many divisions are there in schedule 3, there is a third division also. Third division talks about financial statement of a non-banking financial company whose financial statements are drawn in compliance with the Ind AS. Yes. So if the financial statements of the NBFCs are drawn as per the Ind AS, then the division 3 will be applicable of the Companies Act. And Ind AS is applicable to NBFC now. So there is no exemption per se to them. Like, okay, you don't have, Ind AS applicable to them. I hope you guys are clear. So in that case, NBFCs are required to follow Ind AS. They are required to follow Division 3 for the preparation of the financial statement if the, you know, if the, Ind AS is applicable to them. So there are other things also when it comes to the accounting standards, Ind AS with respect to the NBFC. For example, Ind AS 109. Okay. Can anyone tell me what is Ind AS 109? Ind AS 109.
Financial instruments.
Yes, absolutely correct. Financial instruments. Now, when it comes to the NBFC and when it comes to the application of Ind AS 109, so there are some things that they have to do a bit differently. We will not discuss that over here, but it's just I'm letting you know that there are some exceptions to that. Okay, like ECL model that is there. The NBFCs are required to have a separate ECL policy. Okay, so there is a different application or a slightly different application for Ind AS 109 when it comes to the NBFC. Okay, so there are, different kind of, basically you can say, requirements for the NBFCs when it comes to the accounting, when it comes to the income recognition, and we will run that. Okay. Now quickly I'll come to the notes and we'll start discussion on prudential norms. And I would, ask multiple questions throughout this particular session, and I expect answer from you guys also. Okay. So first we will start with the leverage ratio. Okay. And I will divide everything between the base layer and the middle layer. I'll not go on the upper layer. Reason because when it comes to the upper layer is based on the scoring. 10 top 10 will be picked, then they will be placed in the upper layer. So there are detailed, regulations when it comes to the upper layer, and it is applicable to those 10 only. Top layer is empty. So our focus is basically on the base layer and the middle layer, where the majority of the NBFCs will lie. So let's talk about the leverage ratio first. Now, what is a leverage ratio? Leverage ratio basically is nothing but the total outside liabilities divided by the own funds. So if you calculate the leverage ratio, it is total outside liabilities divided by your own funds. Okay. Now for the NBFC base layer, your leverage ratio should be not more than 7 at any point in time. Means less than 7 should be your leverage ratio. That when you divide your total outside liabilities by net own funds, it should not be more than basically your 7. Okay, so that is for the base layer. And when it comes for the upper layer, okay, now, for the middle layer. So when it comes for the middle layer, as of middle layer, the leverage ratio is required to be kept same if there is a, there is what you can say, if there is no increased risk, till that time leverage ratio will be kept in a similar way for the middle layer also. Okay. For middle layer, I just write as of now similar way. Less than 7. Okay. Now we will discuss about next part is that is your tier 1, tier 2 capital. Now what is tier 1, tier 2 capital? See, when I talk about tier 1 capital, there is a definition of tier 1 capital. Okay, and there is a definition for the tier 2 capital. In last session we discussed about the tier 1 capital. That is the own funds definition. Remember or not? We discussed that. I'll go back to that particular part. over here. Remember, we discussed about net own funds and own funds over here. When I talk about own funds, okay, here, if you reduce own funds by the investment of shares of other NBFCs and perpetual debt instruments, 15% and everything, we discussed, we'll get the tier 1 capital. This is the tier 1 capital. I think I have specified somewhere, just let me check. We discussed in the last session also tier 1, tier 2 capital. Yeah, over here, see. Tier 1, own funds, investment loans, perpetual debt. And tier 2 capital, rest all the things. So this is the tier 1, tier 2 capital that we discussed in the last session. Okay. Now, what is the requirement with respect to the tier 1, tier 2 capital? So for tier 1 capital, I'm talking about as of now, the base layer. So tier 1 capital, basically, if the NBFC is engaged in the gold jewelry loans, lending against gold jewelry. Okay. So requirement for tier 1 capital, base layer. Now, if they are lending against gold, okay, in that case, what is the requirement in that case? Okay, they are required to maintain tier 1 capital at 12%. Okay, I would write T1 at the rate 12% of aggregated risk weighted assets. Now, what is this? Aggregated or aggregate of aggregate risk weighted assets. I'll explain what is this. Don't worry on that. I'll explain in detail what is aggregate risk weighted asset. Okay. So that is the requirement when it comes to the base layer, that they are required to maintain 12% at minimum. Okay. If they are lending against the gold jewelries. Okay. And I will explain that what is your risk weightage, aggregate risk weighted assets. Now, these basically assets are, with respect to the balance sheet. So they are on the balance sheet. Okay. So these are on balance sheet that you have disclosed. Now, when it comes to the middle layer, now what is the requirement then for middle layer? For middle layer, the regulation says that NBFCs are required to maintain, okay, total of tier 1 and tier 2 at 15% of this both, and tier 1 should be at 10% minimum. So tier 1 at the rate 10% again of this aggregate risk weighted assets. Okay. And T1 plus T2 should be at the rate 15% minimum for middle layer. Okay. So that is a requirement for your middle layer and base layer. Now in base layer, you might not have a tier 2 capital. That's why, tier 2 capital is not that much defined. But again, in the middle layer, you have tier 1, tier 2 requirement both. Okay. So accordingly, they are required to maintain these tier 1 and tier 2 capital. We will see with an example also. Don't worry. So I will also show you examples of how they tier 1 and tier 2 are maintained. Okay. Clear till now? Any doubts? Any doubts? Okay.
Sir,
Now what is, yes.
here in middle layer you have told, मैं बस क्लियर कर रही हूँ आपने जो कहा वो, यानी T1 में हमने 10% हम कैलकुलेट करेंगे, फिर जो आंसर आएगा उसको आपने T2 में एनी प्लस किया है?
This one is different over here.
Middle layer.
Yeah. Now T1 plus T2 at B should be at the 15%. Means your tier 1 and tier 2 total should be at the 15% and tier 1 should be at the 10%.
ओके, यानी ये कंडीशन इस तरीके की है, दो कंडीशन है।
Yes.
ओके सर।
So the condition is drafted in such a way that your tier 1, tier 2 capital total 15% there on one side and on other side is 10%.
ओके सर, क्लियर।
Okay. Any further doubts? No? Okay. Now let us see. As I told you, we will be simultaneously seeing that how these things are reported and how these things are actually maintained. See, till the time you will not see a practical example, it will be I think will be difficult for you guys to understand how these things are actually done on the paper or on practical life. Okay, so what we'll do is we will refer to an annual report of a NBFC. Okay, just don't go on the name. It's data is available in the public domain, and just we will see that how this particular thing is reported in the annual report, so that we can understand, okay, what is tier 1 capital and how they have maintained. If you see for this particular NBFC, what they are saying, the capital adequacy ratio as on 31st March 2024 was 22.5%, which has tier 1 at 21.51%. Okay. They have specified what is the tier 1 they have maintained. So minimum we discussed that what it should be and how they have maintained it. Okay. So this is something one reporting they do in the their annual report. Also, I'll show you one more reporting where they specify, okay, what was their weighted assets ratio and how much was the tier 1. Now, if you see over here, this is something the tier 1 they have maintained 21.51, and this is something was required by the RBI. Remember, 10% for tier 1, tier 2, 15%. So this is total of tier 1, tier 2, 15%. Capital to risk weighted asset ratio. And here they have maintained 22.52 and they have maintained 21.51 against 10% and 15% requirement. This is how they are required to report also about the capital. It's not only maintaining the capital, it's about the reporting also. Now, when it comes to the role of auditor, yes, auditor also verifies these things. It's not like that, that auditor will not look into that. Auditor has to verify these numbers because at the end, this is other information also that is given in a financial statement. So accordingly, auditor has to go through this other information. Okay. So we should be aware that how tier 1, tier 2 capital is calculated. Okay. Now we'll go back to the discussions on the what is aggregate risk weighted assets. Okay. And for that, we will go to the study material now. Now, as per the norms or as per the regulations, what RBI says is that in order to calculate your aggregate risk weighted assets, you have to assign weights to each and every asset, first of all. Okay. And then on the basis of that, you need to calculate. You need to assign risk weights to each and every asset. For example, if you see here, bonds of public sector band. So the risk weight or is the percentage weight is assigned 20. So whatever you have to apply that weight percentage, 20%, and then whatever final value will come, you need to take that value. Fixed deposits. Okay. The risk weight is 100%. Okay. Then all asset covering PPP and post commercial operation date COD infrastructure projects. So 50%. Then consumer credit exposure. Okay. It's 125%. Then assets leased out 100%. So you have to assign risk over there. Now, if you see over here, why the bonds of public sector bank has a lower rate? Reason because it has a lower risk. These are the bonds of public sector banks. So these are the lower risk basically. Okay. Then if something has a higher risk, for example, microfinance, everything, so they have a higher risk. Now, the more the risk is given, the more your aggregate weightage assets will be higher. Like, the total of weightage assets will be higher. For example, let's say usually you have 100 over here, so it will become 20. Let's say you have 200 over here, it will become 200 only because it is 100. Now, let's say this is you have 100, it will become 125. Now, the higher the total, if the total is higher, your requirement to maintain the tier 1 and tier 2 capital will be higher because your risk is higher. That's why you need to maintain higher capital. That is the calculation how the 10 and 15% works. So once you calculate this basically on the basis of asset weightage, and then you total it out, and then only you will come to know what is the tier 1 tier 2 capital you are required to maintain. Now, for example, interest due on government securities. Why it is zero is there is no risk that RBI predicts in interest due on government securities. So accordingly, everything is given over here. What is the risk on to these? And accordingly, once you have the total over here, you need to calculate tier 1 into whatever amount will be there. For tier 1, you need to multiply by 10%. And for tier 1, tier 2 total, you need to multiply by 15%. Whatever amount you get, this is the minimum capital level that you need to maintain. Clear with this? That what is your risk weighted assets when it comes to the tier 1, tier 2 capital? So on balance sheet, basically. So these numbers are taken from balance sheet and then you multiply the weights. Okay. I would say over here, refer table. We go back to the notes on page 14.93. Okay. To understand how to calculate. Any doubt with this? Any doubt? Yes, no. Okay. Now that was requirement for the tier 1 and tier 2 capital. Okay. Now we will go to the next requirement. We will go to the requirement for there is requirement with respect to the accounting also. There is a requirement with respect to the income recognition also. Now first we will understand the requirement for the accounting. Okay. Accounting of investments. Now how accounting for investments is required to be done? See, usually when it comes to the NBFC has to divide their investment in certain categories, like whether they are the quoted current investments, okay, whether they are for the short term, for the long term, whether they are unquoted, okay. Based on that, they have to they have to value their investments, okay. So when I talk about quoted investments, quoted current investments, now these quoted current investments for the purpose of valuation will be like equity shares, then your will be preference shares, then you can say debentures, bonds, okay, then you will say government securities. So these will be classified under these categories, or mutual funds or others. So this is how your quoted currency investments are, classified in these categories. Now, how they are valued? The valuation is pretty much very simple. Valuation is nothing but your cost or market value. Cost or market value, whichever is lower. So whatever is lower cost or market value, that will be taken as your value for the investment. Now here, when I talk about cost or market value, it is not at the group level that I need to consider. No. The investment in each category is required to be considered script wise, and the cost and market value aggregated for the all investment in each category. Okay. So I need to consider first script wise the cost or market value, and then I need to consider at the whole you can say group level. Now this is the group equity share. I'll go script by script. I'll see what is the value, cost and market value, okay, in each category, and then I will do the total of that category, and whatever it will be, I'll take it up. If the market value for the category is less than the cost of that category, I will provide the difference to the P&L account. Okay. How to calculate? Basically, simple. First, script wise, then category wise, then if market value is less than cost, difference to P&L. Simple, straightforward, nothing difficult. If the market value is more than the cost, ignore. Clear? This was for the quoted currency investments. Unquoted equity shares. How to value? Very simple. Cost of breakup value, whichever is less, shall be valued at cost or breakup value. Now, breakup value or fair value, you can substitute that. It's not a case. So you can substitute for the unquoted equity shares what is the fair value or breakup value. Okay, so I'll write either breakup value or you can take fair value also. Now, basically, this is unquoted, which is not listed in the market. That's why we are using the concept here, fair value. Okay. And there is one more requirement. If you don't have the balance sheet to decide the breakup value or fair value for the last 2 years of that company, then you need to consider that the shares are valued at ₹1 only. This is exception to this. Exception is if balance sheet for last 2 years of company is not available, okay, then cost is ₹1 only. Simple. Clear? Then comes to the unquoted preference share. Unquoted preference shares, again, you need to value at cost or face value, whichever is lower. Government securities, cost. So government securities, you need to value at cost. Okay. Then unquoted investment in mutual funds. unquoted investment in mutual funds. Quoted because we have already covered above. Now we are discussing unquoted. They are valued at net asset value declared by the mutual fund. So net asset value, okay, that is declared by that mutual fund. Commercial papers at cost. Long-term investment as per the accounting standards. So I'll not include that over here. This is how you need to value your investments basically. Clear? Any doubt? Any doubts?
सर बाकी तो कोई डाउट नहीं है, बट यू हैव रिटन फर्स्ट स्क्रिप्ट वाइज एंड देन कैटेगरी वाइज, इसका क्या मतलब हुआ?
So let's say, for example, you have 10 different equity shares. What I'll do is, for each equity share, I'll calculate the market value or cost. Okay. Then I will total up the market value and I will total up the cost for the all 10 equity shares and see what is the category wise total. So first I will go equity script wise to calculate the market value or cost, and then at the category level I will see what is major, whether the cost is higher or market value.
सर स्क्रिप्ट वाइज समझ में नहीं आ रहा है एक्चुअली.
Script wise means each equity share wise. Let's say, for example, X company's equity share. That's a script.
ओके ओके, यस
That one.
यस सर, क्लियर. सॉरी.
No, sir. Any doubts? Any doubts? Okay. Now, this was, see, wherever there will be a difference, wherever there will be, a different categorization with respect to the middle layer and base layer, I will specify that. But wherever there is no categorization, okay, in that case, I will not, bifurcate. I'll just write for the simple one, what is the requirement over here. Okay, so here as of now there is no categorization required because both have similar thing. So I have written similar way. Okay. Now, basically we will discuss very important part. That is the income recognition and asset classification. The next point in your prudential norms. Income recognition and asset classification. First, we will see asset classification. That is very, very, very important. You have already seen that in past, but again, asset classification, that is really important, and you have some changes over here. Now, when it comes to the asset classifications, okay, asset classification is basically, assets for the NBFC are divided into 4 categories. One is your standard asset. Second is your substandard asset. Third is your doubtful asset. And fourth is your loss asset. Okay. So these are the 4 categories which are divided, which are there for the asset classification. Now, when I say asset classification, base layer has some different definition than the middle layer. Okay. So I will first discuss for the base layer. Now for the base layer, okay, I will start with the substandard asset. I'll tell you there's a specific reason for that. Substandard assets basically is an asset which is classified as an NPA for a period not exceeding 18 months. So that is asset NPA for a period not exceeding 18 months. Means it is less than 18 months. NPA less than 18 months. Okay. Okay, fine. Now, what is NPA? How to calculate NPA basically? When it comes to the NPA, there are again requirements with respect to how to calculate NPA. Different requirements. Okay. This is known as calculation of NPA, or you can say NPA classification, NPA norms. Now, usually NPA earlier, okay, I will write over here. Earlier, NPA for base layer or for NBFCs which were falling under base layer was 180 days. Okay. Now, what is 180 days? Means that the income, not income basically, the principal or you can say interest which was due on that particular asset, or there was a default that that was due but was not paid. So the default is beyond more than 180 days. That was NPA requirement. So the overdue period, basically the overdue period earlier was 180 days. Then it becomes the NPA. That means this is, I'll show you with the help of timeline so that you guys can understand. Let's take the timeline one here. Okay. So let's say this is a timeline basically. Now we have start over here. This is 0 point, means the day when either principal amount, okay, or interest became due. Let's say, for example, the day when the installment was due or was supposed to be paid on that particular loan, and loan is an asset for the bank. Okay. Now this is a zero day. From here, earlier it was that once from the 0 day, if it is not being paid till 180th day, I will call from this day onwards this particular asset. Now we are talking about a particular asset or a loan given to customer. Okay. Now this particular asset or loan will be classified as NPA. Okay. This was the requirement before. This was before SBR, that is scale based regulation. Okay. Before scale based regulation. And that's why I will again, just highlight this so that you guys can understand. This is for the reference. I'm just telling you for the reference purpose. Okay. This was before scale based regulations. But when the scale based regulations came, again a gliding path came. Now the gliding path is something like this. So earlier, the days between 0 to 180, at the 180th day, I was classifying a particular asset as a NPA. Now, what gliding path said that no, don't do that. As of, you need to bring it that to the 90. So on 90th day, somewhere here between, you need to call it as an NPA. So reduce it from 180 to 90th. 180th to 90th. Now, how to do that? Not on a very second day. Okay. So on, let's say, 31st March 2023, you have 180 days. Tomorrow, 1st April 2024, directly 90 days. No, don't do that. Because let's say, for example, if some assets are under 150, 120, or like more than 90, but not at 180. So a day before they were not NPA, now everything is NPA. And there are not many implications for that. Once I classify a asset as an NPA, that's why what was proposed is, let's do one thing. We will again bring a glide path that gradually we will decrease to 90. And that is how was proposed is that, okay, fine. By 31st March 2024, first bring to 150. So this was 31st March 2024. That was proposed, okay, bring it to 150 from 180. Then on 31st March 2025, it was proposed, okay, now to bring 120. So this glide path was given that on 31st March 2025, bring it to 120. And then on 31st March 2026, bring it to 90. So reduce, work in an opposite way. Gradually, year by year, you try to reduce the amount or reduce the days of the NPA, so that, you know, at the end of basically at the end of 31st March 2026, everyone will follow the 90-day NPA norm. Now the question comes is, what we need to follow? We are currently over here. If you talk about 31st March, we are currently over here. But by the end of next year, we will be at 31st March 2026. Okay. So as of today, we are at the 31st March 2025. Or soon, the 31st March will come. As of now, we are here. Okay. So we have a requirement of 120 days that we will also see. I'll show you in the report also, so that you guys can get an understanding. Sorry. Meanwhile, actually the reports are a bit heavier, so it takes time to search the reports, so that I can show you specifically that particular category. Okay. Meanwhile, the report, does a search behind. I will continue and I'll show you in the report also where this, how this glide path is being followed by the companies. Okay. I hope you got now. Now, by the end of 25, the norm is 120, and by the end of March 26, it becomes 90 days. So at the end of March 26, okay, at 31st March 2026, a asset will be classified as NPA when it crosses the 90-day mark. That is, it is overdue for 90 days. When it is overdue for 90 days. Clear with this? Yes or no? No? Any doubts? Yes? Anything? Did you not get anything? Write in comments so that I can understand you are getting the things or not. Otherwise, it's just like, one way I'm providing you the details that I'm not able to understand whether you are getting it or not. Because why it is necessary to understand NPA? A calculation is, now the classification will run on the basis of NPA. Trust me, now whatever classification we will see, it will run on the basis of NPA. Okay, so it is very important for us to understand what is NPA, how the NPA is calculated. Then only you will be able to understand NPA and other asset classification. Okay. Now, why it is important for a NBFC? That why NPA is important for NBFC. I'll show you something with respect to NPA. Basically, when it comes to the NBFC, NBFCs are required to report, okay, on NPA in a various formats. It's not just only one thing. They have to report in a multiple formats, in multiple sections. Now this is one of the section. Again, this is part of notes to financial statement. I'm talking about financial statements. Okay. Now over there you have a concentration of NPAs and sector wise NPAs. That is the reporting requirement for NBFC. For NPA. Reporting requirement for NPA, wherein they are required to report the total exposure from the NPA accounts and the sector-wise NPA that is there in their books, basically. Okay. So what is the total exposure of top 4 NPA accounts and what is the total exposure sector-wise NPA? Means what is the total NPA we are talking about? Now, let's say tomorrow, okay, suddenly if I say, as I'm like, okay, earlier it was 180 days, now it is 90 days. So this, let's say, for example, on 1st April, you will find, okay, no, 31st March, you will find, no, this is 2600. But on 1st April, if I just directly reduce it to 90, these numbers will jump drastically. That's why, a gliding path was given so that, bank, and once I classify an NPA, I classify that as in substandard asset. Then the provision requirement starts. That, okay, what provision is there on those NPAs? Now, if you see total exposure, gross NPA and percentage of gross NPA, they are required to report. Okay. Again, they are required to report on the provision that is there. I'll show you the provision part also. See, net NPS to net advance percentage, but they provide the movements. Means what was the opening balance, additions, reduction, closing, and the provisions for the NPA. Means once I classify a particular asset as an NPA, I am required to make provisions. If tomorrow suddenly I say no, NPA 90 days, it will shoot up, this provision will also shoot up. Because my number increased, NPA number, my provision number will also increase. So these are the certain NPA disclosures that, in financial statement, the NBFC is required to do as per the master regulation. Again, see this. Master Direction, Reserve Bank of India, Non-Banking Financial Companies Scale-Based Regulation, Directions 2023. Remember, we discussed about the SBR directions. Yesterday, I showed you SBR directions. This one, Reserve Bank of India, Master Direction, Reserve Bank of India, Non-Banking Financial Company, Scale-Based Regulation Direction 2023. We are reading that only. That's why it's important for us to understand from where what is coming. I think now you are able to link everything. Okay, this is given in the regulation. That's why that is coming in the financial statements. And that's why it's important for us to audit. See how the dots are being connected. Because it is prescribed in the regulation that the NBFC has to report. As an auditor, that's why we are required to have the understanding of these regulations so that we can audit. Clear with this? Again, this is also part of the same particular master direction regulations. I'll just show you the master directions reporting. See, this is the note 52 is basically on the master direction reportings. Whatever reportings are required to be done under master direction, everything is coming under note 52. And see how much big reporting that part is. So not only here it is still here. There are various other disclosures, but from note 52 here, disclosures based on the SBR, skill-based regulations. Now you have a tier 1, tier 2 capital, again, that is coming into your financial statement. That is tier 1, tier 2 capital coming in your financial statement means you have to audit. Okay, because that part of the disclosure, investments, gross value of investment in India, outside India, provisions, net value. Just now we saw the calculation of the valuation of investments, how investments are required to be valued, because there's a reporting on that. Okay, forward trade, there are other things or reportings also which are there. Okay, then asset liability management, there is other things, we will discuss. Exposures of the loan, exposure to the capital markets. And now we are discussing, with respect to your NPAs. This is NPA. Okay, we'll go back to our notes. We'll continue the discussion on the NPA. That's why it's important for us to understand what is NPA. I hope as of now we are at 31st March 2025, 120th day, but by 31st March 2026, this has to be at 90 days. Has to be at 90 days. So I'll highlight this for you guys so that you can, understand this is a very important requirement. And again, we have a gliding path in NPA. Clear? One thing. Here, I would write that it is only for base layer. Whatever we have discussed is only for base layer, not for middle layer. Now you will ask, why not for middle layer? What is the requirement then for middle layer? Do we have a separate and different requirement for middle layer? See, earlier, before scale-based regulations, NBFCs were classified in two different categories. Okay, I'll just give you an overview. Before scale-based regulations, you will see this particular classification. If it's in your module also, study material. Earlier, they were classified basically either deposit accepting or non-deposit taking. Okay, these were the old classifications. These were the old classifications. One is either deposit taking, we used to call as NBFC D. Another was non-deposit taking, that was NBFC ND. Now there was another classification which was in between of both, that was NBFC SI ND. So that was non-deposit accepting, but see, this is important NBFC because it is related to public. This was not that much critical because it is not related to public, it is not accepting deposit. But again, a new classification was there which was in between, which was, this is systematically important, okay, but non-deposit taking. It is important but non-deposit taking. Okay, so there was a third classification in between. Now 1 and 2, for these two particular NBFCs, already the NPA norms were 90 days earlier, and they both, okay, and they both merged into your middle layer. They both went into the middle layer. ND basically went into your base layer. So for base layer, earlier the requirement was 180 days, which is now being shifted to 90 days to bring a parity between all the requirements. But here for middle layer or for D and ND, SIND, that is systematically important. Okay, for them, it was already your 90 days earlier. So there was no change required with that. And hence, ML from day one has 90 days only, NPA norms. So for ML, it is already 90 days. So there is no change required for the ML. But yes, there was a change required because base layers or ND, the earlier classifications, were having 180 days. Okay, So that's why I am writing for the base layer only, because middle layer already has 90 days requirement. Clear with this? Now we'll go to the asset classification again. When I said asset with respect to the NPA, okay, if a asset is an NPA for less than 18 months, it is a substandard asset. Okay, for less than 18 months, it is a substandard asset. Now comes to the different kind of assets basically. Okay, now what is a doubtful asset then? If a asset is an NPA, asset is an NPA for more than 18 months, that becomes your doubtful asset. Okay, fine. Less than 18, substandard. More than 18, doubtful. Fine. Then what is a loss asset now? Then loss asset basically are the asset identified by internal or external auditors. So these are the specific identified by internal / external auditors. Okay, where you have threat of non-recoverability, either the value of security has eroded or there is some issue, there is a fraud. So these are the assets which are identified by the external or internal auditors, where these are not written off as of now. That's why they are in the books. So in the books identified by external or internal auditor, okay, or where there is a loss of security or there is a threat of non-recoverability on the asset, okay, those are the loss assets because of fraud and error, because of fraud or some deliberate action by the borrower, okay, that becomes your loss asset. So loss asset has nothing to do with the days, it is more onto the identification. Clear? Okay. Now that was for base layer. I'll come at the middle layer. Again, I will write something over here so that you guys can, refer. NPA, then glide path. NPA, this is 90 days. But when it will cross 2026, I'll use 90 days. I'll not use glide path, because glide path by that time it will be over. Okay. Now, when I talk about middle layer and substandard asset, where I was talking about 18 months, here I will talk about asset NPA less than 12 months. Asset NPA less than 12 months. Okay. Where for the doubtful asset, I was talking about asset NPA for more than 18 months. I will talk about asset NPA for more than 12 months. Now, guys, what is loss? Same. It's same. There is no difference on that. Clear with this? Clear with the substandard, doubtful and loss asset classification? Quickly write in comments, yes or no. Thank you, Jenny. Now, there is one category I specifically left. I specifically have not discussed till now. That is standard asset. Standard asset basically okay, is your asset where there is no NPA. So if no NPA, then it is standard asset. Everything is fine, working fine. There is no problem in that. That is a standard asset. Okay, so this is how your NPA norms and asset classification works. Now you might have a question why we are doing this kind of classification. What is the need for this classification? Why we have to do this? Okay. The reason because there are a provision requirement. Once you do the asset classification, then comes the provisioning. Okay. Provision on the asset. Once you do the asset, you take a general 10% provision. Okay, in total. So here it is a 10% general. That you are not required to make specific provision again each and every loan, but a general provision at a total category level. But when it comes to the loss asset or doubtful asset, it's a loan based provision. Against each loan you have to make a provision. Okay. Now when it comes to a doubtful asset again are divided with respect to the provision in two categories. One is secured and another is unsecured. Okay. Now, what is the requirement for secured and unsecured? If it is unsecured, basically, I will go provision with the 100%. 100% provision, unsecured, no any other option. But let's say it's a secured, then there is a year-wise provision required. Up to 1 year, the provision is your 20%. Up to or you can say 1 to 3 years. 1 to 3 years, your provision requirement is 30%. And beyond 3 years, more than 3 years, your provision requirement goes into 50%. I know I've just written, very small over here. I'll just zoom in for you guys. You can, write it in your notes also. But this is how it works. So you have a different provision requirements when it comes to the unsecured. But when it comes to the, secured. But when it comes to the unsecured, you have a flat of 100%. Okay. So this is the provision requirement for the doubtful asset. Clear? How the provision is required to be calculated and why we are doing this calculation. Reason because to understand that what amount of provision we are required to calculate on these assets. Any doubt? Okay. Now comes to the provision on the standard asset. Yes, we are required to make a provision on the standard asset also. So the provision on the standard asset for the base layer is 0.25%. Yes, 0.25% of the outstanding. Okay, is the provision for the standard percent, and that is required to be deducted against NPA. So I will write over here very important point, and I will show you also. Required to be adjusted against NPA. Very important. Now, what is this? The provision on the standard asset. Why we are adjusting against NPA? What is the requirement to adjust against NPA? So I'll show you this with an understanding of the how it is calculated. Well, just a minute, I'll show you. it is taking a bit of time to find that particular part. Okay, by the time it will find, I'll show you something. I'll show you. Meanwhile, we'll continue. But what it happens is, once we calculate this particular amount, then this particular amount is basically adjusted against your NPA. Okay, so once you basically calculate this amount, then this amount is adjusted against the NPA to derive that what is my net NPA. I have to deduct the provisions out of the NPA to get my net NPA, and this particular provision also reduced from that particular part. Okay, so I actually, it is taking a bit of time to search in the file. Okay, meanwhile it will say, okay, here it is. I'll just give you a glimpse of that. See, if you see, there is a asset classification over here, and there is a provision. This is a loss allowance or provision as required. Okay, and sometimes you need a provision basis on the norms also. So whatever provision is required, you take this provision, you deduct it from the carrying value, and you get the net carrying value. Same it for the NPA. Even if you see when it is disclosed in the financial statements schedule, okay, when the NPA is disclosed in the financial statement schedule, over there also it is disclosed as a net NPA after reducing this amount of what you say provision. So these provisions are reduced from the gross NPA to arrive at the net NPA. And that is a net exposure. Basically, we see any, like, whenever you hear anyone talking about what is the gross exposure, what is the exposure in the balance sheet of NBFC, they are talking about this kind of exposure, NPA exposure. So this is how the NPAs are calculated in actual, and this is how they are reported in the balance sheet. Clear? Any doubt? Any doubt? For how much time NBFC will make provision for NPA, within how much time it can write off. See, how much time basically means that NBFC, it is not easy to write off in case of NBFC. That's why you have a securitization companies. Remember, securitization companies that purchases bad loans from the banks or NBFCs, and then they try to recover it. Now, writing off loans is not that much easy in case of banks or NBFCs. But till what time they are required to make provision? Till the time they have the loan in their books. Okay, or the asset in their books. I will not use the word loan, rather I will use the word asset, because there could be multiple type of loans or assets, okay, on which the NPA, which can become an NPA. Okay, so that's why till the time they have the asset, they are required to maintain the provision on that as per the norms. Any doubt? Any other doubt, guys? And a detailed reporting is done actually on the NPAs when it comes to the financial statement. I will show you example also of a detailed reporting. Okay, so this kind of detailed reporting is already done when it comes to your financial statements. Okay, if no doubts, then let's proceed further and discuss. Okay, now we will discuss, this was what we were discussing, is we were discussing on the NPA norms and asset classification. We discussed this for base layer, we discussed asset classification. For the middle layer also, we discussed the asset classification. Okay, we discussed for the base layer what is the provisioning requirement. Okay, now we will discuss for the middle layer what is the provisioning requirement. Okay, for the basically standard asset, when it comes to the provisioning requirements for the middle layer, okay, it is 0.4%. Okay, for the middle layer, for standard asset, it's 0.4%. Okay, now what about other categories? For other categories, whatever we have discussed till now, okay, when it comes to the substandard, when it comes to the doubtful, when it comes to the loss asset, it is same. So provisioning requirement for substandard, doubtful, and loss, okay, is same. It is not, so it is not different for the middle layer. So I would write same, and again same. Except for the standard asset, there is no change in the provisioning requirements. The same provisioning requirements are also applicable to the middle layer. So you are not required to remember different numbers when it comes to the provision for the middle layer. Okay. So that was your provisioning requirements when it comes to the base layer and the middle layer. Now there is one more requirement. Okay. That requirement is known as a SMA reporting requirement. I'll explain what is SMA. Now, till the time, see, first understand why this requirement is there. Till the time a asset has not become an NPA, I have to wait till 90 days to become an NPA. Okay. Let's say, for example, on 60th day, I cannot say this asset is an NPA because 90 days has not been, yet over. So in that case, what happens is till 90th day, I cannot do anything because still that is an standard asset. There is no NPA. There is nothing I cannot classify that asset in NPA. So there was a gap, that this particular gap. Okay, till 90 days we have to wait to call an asset an NPA and do something then. So what happened is a new categorization came into place. Okay, when it comes to the standard asset, because for substandard and above, those are already NPAs. Okay, but for the standard asset which are not NPA but where still you have a overdue amount, means there is an amount which is not paid on that asset but it is yet not classified as an NPA. Reason, because those days have not been passed. For them, there was a SMA reporting requirement. Now, what is this SMA reporting requirement? SMA is known as special mention accounts. Special mention accounts. SMA categorization, you will hear SMA reporting or SMA categories. Okay. Now, what is this particular SMA categories? SMA categories were divided into, again, three categories. I will distribute in base layer, middle layer, both. So there was SMA 0, there was SMA 1, and there was SMA 2. These three categories were there. Okay. And this is applicable to the asset where there is a overdue. Applicable to asset where there is any overdue. Then only I will start, calculating the days. Otherwise, why will I calculate the days if there is nothing overdue on that? Okay. So first, let's understand with respect to the base layer. When it comes to the SMA and when it comes to the base layer, so basically up to 30 days, From the day the overdue starts, again, from the day when overdue starts up to the 30 days, I will call as an SMA 0 account. I will call as an SMA 0 account. When it goes to more than 30, but less than 60 days, I will call as an SMA 1 account. When it goes to more than 60 days, but less than, now this is very important. As required days, it will be called as an SMA2. Now, what is this as required? Remember glide path that we discussed over here? Now, this 120 day, we are as on 31st March 2025. As on 31st March 2025, this as required as per gliding path, okay, will be here. Like whatever from the day when it will be counted as an NPA, that day will come here. So, as required as per NPA glide path, that day will come. Means now we will consider from 60 to 120. From 60 to 120, we will consider as an SMA2. But when we will reach to 31st March 2026, we will say from 60 to 90. Because at that time, NPA will start from 90th day. Okay. So based on this glide path, I have to, adjust this particular as required number over here. So now it is 60 to 120, but later on in future, it will become 60 to 90. Okay. For example, now 60 to 120, future 60 to 90. Okay. So this is, it means that as required as per the NPA glide path. This was for the base layer. Now, when it comes to the middle layer, okay, middle layer, up to 30, pretty much same. 30 to 60, same. Now here, as there is no glide path, basically, when it comes to the middle layer, we directly have more than 60 days, but less than 90 days. After 2026, everything will be same. There will be no different SMA different categories for middle layer and base layer. Everything is same. Now this is different just because of the glide path, but after 26 it will become same. Now why this is required? Okay, why we need to do? As I said, I'm not required to wait till it becomes an NPA. Once I classify this as the SMA 0, SMA 1, SMA 2 accounts, there is a guidelines or there are regulations that what bank is required to do for the follow-up or for recovery of that amount, of the overdue amount from that borrower. So these accounts are flagged by the banks as an overdue, or the lending institutions, or basically NBFCs. Okay, and there are certain policies, there are certain things that they are required to do behind these accounts. So don't wait up to it becomes an NPA, but do something before that only. That is in principle over here. Clear? Any doubt till now? Any doubt on anything that we have discussed?
Sir, can you explain SMA example? Which asset
Yes.
falls in the SMA categories?
Yes, no issues. So when it comes to the SMA, I'll just explain you. Okay. So let's say, for example, I'll simply take a term loan. Installment was due on 5th Jan 2025, which was not paid. Simple. Okay, not paid. 5th Jan 2025, installment due, not paid. I'll not go into amount as of now. There is no need for amount. Okay, fine. Installment was due, they did not pay. Now the SMA calculation will start. What is the SMA calculation? From 5th Jan to 5th of, sorry, not 5th of Feb, because I have to work in days. So I have to actually calculate basically the days over here. 30 days. Just a minute, I'll calculate date. Yeah. From 5th, I need that how many days it will become for 30 days. So it will be 4th Feb. This is nothing but the 30 days, up to 30 days. It will be classified as an SMA 0. From 5th Feb, okay, now I'm talking about 5th Feb. From 5th Feb to basically it will go like it has 28 days in the March. So it will go to 7th March. Yeah. So till 7th March, it is SMA 1. Why? Because it is 30 to 60. 30 to 60 days. So from 5th Feb to 7th March, it will be classified as an SMA 1. And assuming this is middle layer as of now. For simplicity, I'm talking about this is middle layer. And then from 7th of March, okay, I need to see, okay, what, then it becomes the 90 days. Okay. So from 7th of March till your 6th of April, it is SMA 3 or SMA 2 basically. Okay, because 60 to 90. Beyond 6th April, it is NPA. So after this date, after this, it will be classified as a NPA. Okay, and once the NPA classification is starts, it transfers from the standard asset to substandard for 18 months. Over here, it is 12 months. Now it is a middle layer. So it will be 12 months. For 12 months, basically, that is from 6th of April 2025 to 5th of April 2026, it will be a substandard asset. Then loss asset, then doubtful asset up to 1 year, 1 to 3 years, more than 3 years, like this way.
Okay, sir. Got it.
Sir,
Yes.
this SM2 category will be from 8th of March, na sir?
8th of?
8th of March till 6th April.
Yes, my mistake. 8th of March. Yes. Yeah. 8th of March. Then it will be 7th over here. 8th of March to 7th. Okay. So this is how the SMA classification works. Any doubts? Any doubts till now? What is meant by SHG loans on page 14.9? Just let me check. which loans you are referring to. $14.94. Just a minute. Specifically, can you tell me where it is on the 14.94, this particular part that you are referring to? So can you just let me know which where you are referring to this 14.94 part? Point number 3E. 3E, 3E. Okay, over here, microfinance and this one. Okay, this is nothing but your call as an self-help group. Okay, small groups which are there, just like small vendors. Okay, you provide loan to them. Self-help groups. Basically, there is a scheme financing to the self-help groups. So there are loans given or benefit for the self help groups. You can say it's kind of they are groups. They are kind of people who are, there's a group of people, basically people. They are working for a particular motive, like agriculture or something like that. Any other doubts? Any doubts? No? Okay, if no further doubts, what we propose is, let's take a quick 10-minute break. We have discussed a lot of things now. Let's take a quick 10-minute break, try to grasp the thing what we have discussed, and then after the break, we'll continue the session. Now we have to report on the reporting part also. This was basically we discussed on the provisions and substandards and everything. Okay, we have to also discuss on the simultaneously the reporting part. What is the reporting requirement when it comes to the provisioning, substandard, and everything. So I will also start up the simultaneous reporting section after the break. Okay, let's take a quick 10-minute break. Yes. स्टार्ट करें क्या? Okay, let's continue the session. सेशन सर ब्रेक ओवर कर दीजिए. Am I audible to you guys? Okay, let's continue the session then. If I'm audible, just let me know I'm audible. Okay, and if at any point in time if you feel that okay I am not audible, then just let me know. Okay, now what we are going to discuss is a very very important part, that we are going to discuss about the reporting for the auditor. Okay, just let me know also if I'm audible, and if I'm not audible also let me know. So we will discuss about the reporting for the auditor. Okay, now what is the reporting requirement for the auditor? Now what is the role that what is the role of auditor over here? Okay, that is very important to understand. Yes, some can be the practical questions can be there on the provisioning. Yes, no doubt on that. So in exam, practical questions on the provisioning can also be there. Okay, now basically when I talk about auditor's role, auditor has to report on multiple things. See, first of all, when there are things which are required to be reported on in the financial statement, auditor has to look into those areas. Okay, it's not just like okay, auditor will not look into the areas which are there in the financial statement, and then he will just report on some few things other than the reporting requirement over here. It's not like that. Auditor has to see, is there any specific reporting requirement with respect to these regulations, these master directions in the financial statement? If yes, then whether the disclosures have been made in the financial statement or not. Okay, so when it comes to the specific reporting requirement, auditor has to make sure that has been done. That is done in the financial statement. Now, basically, what are these reporting requirements? Specific reporting requirements. So there is a section basically in the master direction which talks about specific regulatory reporting. Okay, in notes to accounts with respect to NBFC middle layer, NBFC base layer. So the based on the the categorization, based on the layering requirement, there is a reporting requirement also. Okay, now what are these reporting requirements? Basically, there are asset liability profile reporting requirements. There are capital ratio reporting requirements. We'll see that in a while, now in some time only. But there are various these reporting requirements. And based on that, auditor is required to verify whether he has, whether the company or the NBFC has reported or not. So I'll show you one such reporting requirement. We'll go to SPR. That is, when I say SBR, it's a scale-based regulation. Okay, so I'll go to specific reporting under disclosure in financial statements. So basically, this is Annexure 7, which talks about specific disclosures in the financial statement notes to accounts for an NBFC. Okay, now this talks about specific disclosure. Now these are the general comments on that. Okay, some general things which are there, that current period financial statement comparators should be there. Okay, and specific things should be there, like that way. But the actual reporting starts from here. This is the section 1, applicable on the annual financial statements of NBFC base layer, middle layer, and the upper layer. which talks about exposure to the real estate sector. So first is the exposure related reporting requirements. First one is the exposure to the real estate sector. Like what is the exposure that is required, that is there for the real estate sector for the NBFC. Okay. Then you have exposure to capital markets. What is the exposure of NBFC to the capital market? For example, remember we saw valuation of investments. Same here, like direct investment in equity shares, bond, convertible debentures, mutual funds, advance against shares, advances, other advances. What is the exposure basically to the capital markets for the NBFC? Okay. Then you have a sectorial exposure requirement, sector-wise exposure, total exposure in balance sheet. When I say exposure, that is being loans and advances that are given to that particular sector. Now, this is a kind of exposure over here that we are talking about. Direct investment, advances, and everything. This is basically in general known as an exposure. If you give any loan, if you have any asset with respect to that, any advances, that is an exposure. Okay, secured, unsecured, some kind of thing. So if you have any, so once you give exposure to the capital market, then you need to provide sectorial exposure. What is your exposure to basically agriculture, your exposure to services, your exposure with respect to personal loans, industry related, various industries, everything. Then you need to provide total exposure, gross NPA, percentage of gross NPAs, okay, NPA to that total exposure, and previous year. Then you have an intergroup exposure, okay, that you are required to report. Then you have unhedged foreign currency exposures. I'm just taking you to the overview, and then we will go to the specific also. Related party disclosures, okay. Again, if you see related party disclosures, parent, subsidiary, joint venture, key managerial, relatives, others, with respect to the borrowing, deposits, specific, other than whatever we have seen, wherever we have seen reporting requirements, this is a specific master regulations or master directions reporting requirement. So there might be a reporting requirement. Let's say, for example, if a particular NBFC, okay, is listed, then there is a LODR requirement, reporting requirement. Okay, so LODR might have a related party requirement that is separate. Companies Act section 188 might have a separate reporting requirement. Okay, related party related party transaction reporting, that is separate. Your NDS might have a separate reporting requirement. Again, that is separate. But when it comes to master direction, this is over and above that particular reporting requirements in the related party sector. Okay, there are other multiple reporting requirements. For example, disclosure of complaints. Now, how this reporting is given, like we are going to the reporting, but how these reportings are given. Now, that was for the base layer. That this is the reporting which is specifically applicable to the base layer, middle layer, and means general reporting and upper layer. But if you go to the section 2 of this reporting, basically it shows you that specific reporting that is applicable only and only to middle layer and upper layer. I'll just show you. Yeah, so this is specific reporting to middle layer and upper layer, not to the base layer. So this reporting is not there, like capital capital reporting, tier 1, tier 2 capital adequacy ratio reporting, investment reportings, okay, derivatives reporting. And how it is actually reported, I'll show you. Remember note 52 that we were talking about? I'll go quickly to the note 52. Yes, over here. Note 51. Yeah, note 52. Now, remember, see this one. SBR capital related reporting requirements. Over here, this is your SBR capital related reporting requirements over here. So same way, investments in India, outside India, your forward rate derivatives, swap, quantitative disclosures. Now then you will have a general reporting, exposure to the real estate sector. From here you have that general reporting that we saw in Action 1 or Section 1 basically. Okay, exposure to the real estate sector, exposure to the capital market. Remember, now just we discussed intra-group exposures, unhedged foreign currency, parents, single borrower, everything. Then you have the credit rating related disclosures, remuneration to non-executive directors. We also saw concentrations of NPA, sector-wise NPA reporting. Just now we saw in that. Okay, we earlier also discussed sector-wise reporting. Remember, agriculture, industry, service, personal loan. Then we saw number of complaints, related disclosures. Now these disclosures are already given under the master direction that the NBFC has to report. Now, if NBFC has to report, your role as an auditor comes into the place that how have you verified that reporting is appropriate? So audit procedures regarding this particular disclosures is also required to be done. See, tomorrow, there could be an incorrect reporting. Then you will be say that, okay, whether the financial statements in all material respects comply with the applicable financial reporting framework. So these are the financial statement. This is the notes to financial statement. Now, if that reporting is incorrect, which is not as per the applicable financial reporting framework, then how can you give an opinion that, okay, in all material respect, it actually, complies with the requirement? As a result, we have to make sure that we understand these requirements with respect to the presentation and disclosures in the financial statement and whether those presentations and disclosures have been achieved or not. That is the first part of the reporting. This is the first reporting that is done by the NBFC, and auditor has to audit these particular presentation and disclosure. Now comes the second part. Is there any other reporting requirement? Answer is yes. We discussed in the last session also. There is a basically NBFC company's auditor report Reserve Bank directions. Okay. Now here, under these directions, auditor has to report on certain matters to the board of the NBFC. Now it is not in the public, it is reported to the board of the NBFC. So an additional report is submitted to the board of directors. In addition to 143, in addition to 143.3, Rule 11, all those things, in addition to that, this particular reporting requirement comes into place. Okay, means here auditor reports over and above what we do as a reporting under Companies Act, under CARO, under any other law or regulation. So here auditor has to submit a report. And then what happens is, once this report is submitted to the non-banking financial companies board, they have to, okay, they have to submit a basically, accept of this report to the bank. Or, even it is the responsibility now, it is the responsibility of the auditor to submit a summary kind of thing to the bank. When I say bank, it's a RBI. So they are not only required to submit to the board of directors, they are required to submit to the Reserve Bank also, RBI also. Okay, if there is an unfavorable things, if there are some qualifications, then with respect to that, a report is also required to be submitted to the Reserve Bank. So there's a dual purpose reporting which is happening over here. A report to bank on all the matters, it's there. But when there is an unfavorable matter, also report to the RBI. Now, to whom this is applicable? It is applicable to the company defined under 45 IF of the Reserve Bank of India Act. So every auditor of the NBFC, okay, every auditor of the NBFC, it doesn't say that middle layer, upper layer, base layer or anything. To each and every category of NBFC, it is applicable. Instead of reading from the this particular provision or the directions, we'll go to the study material, because in study material it is already given. Okay, we'll go to the study material, and now we will refer this compliance report. This is point number 7. Basically, it is the same report that we are discussing. Okay, this is a compliance report that we are talking about now. Again, there are master directions on the supervisory returns that we will discuss. But again, this is the compliance report that is there. Now, what is this compliance report about? Okay, what are the points that we are required to report under this? Basically, there are two categories in case of reporting under this. So we call this particular kind of reporting as a, you can say, NBFC's auditors report to board. Okay, so for the sake of simplicity, we'll call this NBFC auditors report to board. Okay, now under this particular reporting, there are two different sections or two different categories, I would say, where the reporting is structured or how the reporting is structured. Number one, or category A, is that is reporting on matters for all NBFCs. Means by default that for all NBFCs, the auditor has to report on these matters. Now, matters are specified. When I say these matters are specified in para 3 of directions. Just like Caro, we have a para 3 of Caro where all the reporting requirements are there. On a similar way, there is a para 3 of these directions where everything is defined. Okay, so para 3 of the directions specify this kind of thing, like what are the matters. Okay, and that matters are divided in two categories. One, that is reporting applicable to all NBFCs, like auditor is required to report on those matters, okay, for all NBFCs. Category B, reporting in case of NBFC accepting public deposit. If the NBFC is not accepting public deposit, B category will not be applicable. So the matters which are specified in B category, which will not be applicable to them, or auditor is not required to report on B category matters. Okay, so A category matters, irrespective of the type of NBFC, I'll report. B category of matters, if the NBFC is accepting deposit, then only I will report. Clear? Quickly in the comments, let me know whether it is clear or not. Okay. Now, what is A category matters? What are the A category matters? A category matters basically deal with the matters related to certificate of registration, matters related to the net own funds, matters related to the basic requirements of NBFC. Like, for example, this is A in case of all NBFCs, matter category A. Okay, so this is category A that we are talking about, applicable to all NBFCs. Now, what is this matter? The first point is that whether the NBFC is conducting business or the activities of NBFCs without a valid registration of certificate, without a valid certificate of registration. So conducting NBFC's activities without valid certificate of registration. Very important point. What is NBFC activity? Can anyone tell me quickly? What is NBFC activity? Where it is defined? What is NBFC activity? Where it is defined? Come on, quickly, fast. Wait, what is the NBFC activity? No? What are the activities that an NBFC does? We have discussed this. I am not receiving any answer. That's not good. Means you guys are not focusing on the lecture, not listening to the lecture.
Sir,
Loans and advances. Yes, good, Ginny. Very good. But where it is defined? Where it is defined? That is necessary for us to understand. Where it is defined, the NBFC activities.
RBI.
Yes, Kriti, very good. Very good. Yes. That is where we have defined what is a non-banking financial company. Plus, there is one more section. Okay. Now I'll show you. 45 IF. Why we forget that what is a NBFC? This is definition of your NBFC. Okay. So NBFC means either it is receiving deposit or lending or such other banking institute or class that is, doing as specified by the central government. Plus, there's a business of NBFC which is defined over here. Business of a non-banking financial institution in 45 IA. Why you guys forget? I don't know. 45 IA means carrying on business of financial institution or NBFC under clause C and F. So if you are doing clause C business, clause F business, you are doing a business of NBFC, a bank, non-banking financial institution. Yes or no? And even that we discussed that in our section 45 IA, that business of a non-banking financial institution which is defined under 45A, that is C and F again, should not be done without obtaining a valid certificate of registration. Now, that is the same reporting requirement that is coming over here. Whether conducting non-banking financial activity without certificate of registration, which is as specified under section 45 IA. Read with, okay, your section 45 I, A, C, and F. Simply that what we have discussed in the first session. See over here, it is written also in that particular part. Therefore, if the company is engaged in the business of non-banking financial institution as defined in 45 IA of RBI Act and meeting the criteria, principal business criteria 50-50, shall obtain a valid certificate of registration from RBI. Means every NBFC that is doing the business of NBFC defined in 45 IA, which again referred to CNF, shall obtain a valid certificate of registration, and they are also, if they are meeting the principal business criteria, that is the 50-50 criteria. Number 2, that was certificate of registration, COR requirement, obtaining COR. Once you obtain the COR, banks are required to maintain the COR. Okay. So the second reporting requirement is whether they are entitled to continue hold such COR in terms of principal business criteria. As on 31st March means as on 31st March, check 50-50 criteria in order to report under that? Yes or no? So whether the company is still, maintaining the 50-50 criteria, that you need to report. Principal business. Remember 50-50 criteria that we discussed start of the session also today? Okay. Now, once this principal business criteria is there, okay. Now, if you see principal business criteria, it is required to be followed by each and every NBFC. It's not like that, only a particular NBFC has to follow. Principal business criteria is followed by each and every NBFC because they have to maintain this criteria and the auditor has to report on these criteria. Okay. Once the auditor reports, okay, whether they maintain this principal business criteria or not, then in that case, what they are required to report also basically is that whether the net on funds are being maintained or not. Means apart from principal business, now the net on funds requirement is also there. So whether the company, non-banking financial company, is meeting the requirements of net on funds as laid down in scale-based regulation. Okay, so as it is specified in the scale-based regulation, it is, whether it is meeting the requirement of net on funds or not. What is the requirement of net on funds? Quickly, guys, for the base layer. Net on fund requirement quickly. Quickly, what is the requirement for the net on funds? No. We discussed the requirements. Yes, Kriti. So the net on funds requirement, usually it is 2 CR old limit, but for ICC, MFI and factor, it has to be increased to 10 CR. But for NBFC, IFC, IDF, different are there. For P2P, AA, ND, 2 CR. So different net on fund requirements are there. Yes or no? That we discussed. So for the net on funds, different requirements are there. And based on that, auditor has to report whether the net on funds requirement is being met or not. Okay. And that is again becomes part of your report to the board of directors. NBFC's auditors report to the board of directors. Over there, you need to report. That's why you need to have an understanding, okay, how the net on funds for the NBFC is calculated so that you can report. Okay. Now, we'll go back to again reporting requirements. That was the reporting requirements category A, that is obtaining COR, then 50-50 criteria, then net on funds criteria. Okay. That is a category A reporting requirement. Once this report is submitted to the board of directors, this basically report is submitted to the board of directors, then the company is required to submit this report to the regional office of RBI. Okay, so a certificate from the statutory auditor that this particular report, okay, reference to the position of the company at the end of financial year of 31st March is required to be submitted to the regional department of the RBI with respect to the NBFC by end of 31st of December, but not later than that. So once the basically the due date for year closes, then they have to report by the 31st of December that whether the the NBFC is eligible to hold the certificate of registration or not. Means whether they are meeting the principal business criteria, whether they are meeting the criteria for the net own funds. By the end of 31st December, they have to report to the, or they have to submit this particular details to the Reserve Bank. The company has to submit, and for that auditor has to provide to the company. So how it works is, auditor will prepare, will give it to company, and company will give it to the RBI. Okay, and that is as on 31st March. As on 31st March, what was the requirement, or whether it is eligible to hold or not? Not during the year, not at any point during the year, as on 31st March. For the financial year ended 31st March, I'm talking about position on that date. A company might have a net own funds more than the required amount during the year, but around 31st March, they were not having that much in net own funds. So they will be not eligible to hold. Okay, so as on 31st March, it is required to be reported. Clear with this? Yes or no? Okay. Now that was category A reporting, primarily on certificate of registration, which includes your 3 points. Now comes the category B reporting, if they are accepting or holding public deposits. Over here, the reporting requirement increases beyond your certificate of registration. Now, what are these reporting requirements? Number one, now we are talking about accepting public deposits. So, whenever a NBFC accepts public deposits, at that point in time, whether these public deposits which have been accepted are in compliance with the regulations or norms that have been issued by the RBI. Same, that is the first point that we are saying, that whether the public deposit accepted by the company, okay, including by public issue, from its shareholders, from entities, are in compliance with the NBFC acceptance of deposit directions or not, or whether they are in limit with these directions. Okay, so whether they have complied the direction for acceptance of the deposits or not. So compliance with the direction is the first point.
Sir, any ratio of deposit taken?
Compliance with the directions of deposit acceptance. That is the first point. Now, that direction usually also specifies what is the maximum amount they can accept the deposit. Tomorrow I start an NBFC, I have a net on funds of, let's say for example, 5 CR, 10 CR. I'm accepting deposit of 1000 CR. I cannot do that. There is a limit. I cannot accept deposit of, based on my whims and fancies. No, I cannot do that. I have to follow a regulation. I have to decide a limit. A regulation specifies the limit. Okay. So when a NBFC accepts these deposit beyond the limit, they have to return it back. Simple. If you have accepted, return it back. So first of all, auditor has to tell that whether the deposit whether the public deposit held by the company are in excess of that quantum, that threshold. Yes or no, that is they need to tell. And whether they have been regularized in the manner provided. Regularized either means returning, or either by way of increasing your limit by complying with certain norms and regulations. So the second point is threshold and regularization of deposit. Okay, that's where auditor needs to report. Kirti, actually the difference between NBFC, ND, NDSI or SIND basically, or NBFC-D was the earlier classification. If you refer to my the last session, I detailed discussed that, okay, what was the earlier classification? Okay, how earlier they were classified, like non-deposit taking, deposit taking, or deposit taking, non-deposit taking, but systematically important. So these were certain earlier things which were there, but now it has been done away. It is scale-based regulations now. So NBFC, ND, NDSI, or NBFC-D, they are not relevant as much today. Any other doubt, guys? The doubt with respect to the Nidhi company and NBFC, I'll take it at the end because there is a difference that I will be telling you. Okay, but I will take it at the end. It's a very good difference, I would say. Okay, when it comes to NBFC, Nidhi company,
Sir,
and
my
what you
question
say,
first is
NBFC.
कि when we talk
Okay,
about
I'll
Nidhi
take it at the
company.
end. Don't worry, but I'll definitely take it. Now, let's talk about further reporting requirements. Okay. Now, what are the further reporting requirements when it comes to the accepting deposit? See, now we will be talking about acceptance of deposit only. Okay. We will be talking about acceptance of deposit only because it's a specific category. The next part is that each and every deposit has a credit rating. Deposit schemes have a credit rating. If I show you credit rating, uh, I'll show you a live exam, the examples of a credit rating basically, so that, you can understand what is a credit rate, how credit ratings are there.
Hello, sir.
Okay. I'll just show you. See, so these are certain credit ratings which are there. Basically, if you see over here, so there are this particular, type of instrument, and below here, these are the credit ratings by CRISIL, by ICRA, by Indian Ratings and Research Private, by CARE Ratings on programs. Now it can be fixed deposit program, it can be short-term bank loan facility, it can be different programs where there is a credit rating. Same way for the deposit, you should have a credit rating. Okay, for deposit acceptance also a credit rating is required. Uh, I'm not sure your voice is there. Just let me check if it is.
Playing from Harshad PC.
Just a minute. Let me see if there is some issue with the voice. Okay.
Hello, sir.
Uh, just a minute. Let me see. I'm not able to get anything. Can you repeat your doubt again? If you are saying something. So that your name is appearing as a 1+. Were you saying some doubt? Can you repeat your doubt again? Okay. No issues. Do let me know if you have any doubt. I'm not able to get your voice, guys. Is there any, can you try to unmute yourself and then try to speak?
Hello, sir.
Your voice is now audible, Ginny.
Yes, sir.
But earlier I was not getting any voice. Might be some system issue. So if you guys have any doubt, you can unmute yourself now. You can also ask. No issue, or you can write in the chat box.
Yes, sir. Actually, OnePlus again and again got asking, and we can hear her voice, but to you, the voice could not be reached. That's why.
Might be some problem with the system. Sorry for that. Apologies.
Thank you, sir.
Okay. So guys, you can ask your doubts by unmuting yourself. Okay. Then I'll continue the session. Okay. If you have any doubts, you can ask. Now, as we were talking about basically with respect to ratings. Okay. Now, these ratings are necessary for the deposits also. Now, if these ratings are necessary for the deposits, then auditor has to report on that whether the ratings were obtained or not. Okay, whether the public deposits that are accepted or any scheme of public deposit is there that has a minimum investment grade credit rating or not. Okay, so that is a point that auditor has to report. So it should not happen that, okay, there is a program, but there is not a credit rating attached to it. So each and every acceptance, public deposit acceptance program or scheme should have a minimum credit rating, a minimum investment grade credit rating from an approved credit rating agency. Okay. So minimum credit rating reporting is there. That is required to be reported by the auditor. Then auditor has to report on the capital adequacy ratio. Remember the tier 1, tier 2 ratio that we saw, that we discussed. That is, we discussed because auditor has to report whether the capital adequacy ratio as disclosed in the return. So there are returns which are submitted by the NBFC also. Now these returns, like these capital adequacy ratios are reported appropriately or not. So correctly determined and reported in compliance with the minimum CRAR. So what is the minimum CRAR reporting? Like what is the minimum capital adequacy ratio for tier 1 and tier 2 for middle layer? Can anyone tell me quickly? Requirement for tier 1, tier 2, middle layer. Anyone? Requirement for of tier 1, tier 2 capital for middle layer. What was that?
Sir, tier 1 10% and tier 1 plus tier 2 it should be 15%.
Yes, absolutely correct. Very good. So tier 1 10% and tier 1 tier 2 15%. Okay, so that we saw, and that is whether that has been reported or not by the bank. Now that is required to be calculated also, and that is required to be reported. So auditor has to verify whether they were calculated appropriately, whether they were reported appropriately or not. Now again, in case of NBFC that has a credit rating, now that the minimum credit rating that we discussed. So in case of that particular NBFC which has accepted deposits and they have the credit rating, okay, whether that credit rating is in force, you might have seen that some agencies are changing the credit rating. That credit rating was downgraded or credit rating was upgraded, or this was done with the credit rating. You might have heard in the news, yes or no? Anyone heard this thing particular in the news that the credit rating was downgraded for this particular entity or this particular investment scheme or something like that? Yes? No? Okay, no issues. If you are not heard, okay, you can go and check the news. You will see that, okay, the credit rating has been downgraded for these particular investments or entities. It happens. It happens frequently. It's not like that, it's not that, but it happens. Like sometimes banks downgrade, sometimes banks neutralize or change the credit ratings, okay, on a periodic basis. So on a periodic basis, credit ratings are re-evaluated based on certain things. Now what happens is that if the credit rating has been removed, if that has been changed, in that case, whether it is still in force, like whether it has still minimum investment grade credit rating, so that auditor has to report. Okay, so auditor is required to report on that particular part, whether the credit rating is still in force or not, whether it was downgraded, whether it was actually it was taken below than the minimum investment grade credit rating. If yes, then that auditor has to report now. So I'm not sure you guys have that you guys have anywhere read or not. Can anyone tell me that anyone has read like what is minimum investment grade credit rating? Have you read somewhere what is minimum investment grade credit rating? No? So different credit rating scales are there. Okay. Different credit rating scales are there. AAA, AA, A, triple B, double B, B, C, D, like this way. Okay. And when I say what you say, B, C, D, they are more into default and high risk categories. Okay. But when you go with A, AAA, they are considered to be good ratings. So there is a investment grade credit ratings. There is a guidelines also from RBI. This is a circular that on a periodic basis they have to review the respective credit ratings. Okay. So RBI from time to time decides what is the minimum investment grade credit rating. So as of now, if you see, there was a circular of 2022 which talks about triple B minus. Okay, triple B minus is the minimum investment grade credit rating. Minimum investment grade credit rating is triple B minus. Yes. So that is something that is required to be maintained. Now, if anything goes beyond below that,
But Moody's, as per Moody's, it's BAAA3, right?
yes, as I said, like different agencies has a different way of calculating the rating. Okay. Now, when I talk about Moody's, it has AA1, AA2, AA3, the BAA1, BAA2, BAA3. They have a different. So basically, this is based on long-term debt, whether it's a public deposit, whether a fixed deposit scheme. So it depends on that. So type of scheme, type of rating agency, all that depends like what is the credit rating it is there. But when I talk about NBFC, when I talk about deposits, there's a RBI circular which talks about triple B minus is the minimum or something similar if anyone else is following.
Okay, sir.
Okay. Now this was basically with respect to credit rating. So that credit rating is in force or not, that is very important to understand. Or it is, let's say for example, it has been classified as a beyond triple B minus or BAA3 or something like that. So that is required to be reported by auditor, whether it is still in force or not. that credit rating. Okay. And like, same way, these credit ratings specify the credit limit, or the limits also. So with the credit rating, you are being assigned a limit, basically, like what is the limit of your accepting fixed deposit. So at any point in time, have you exceeded that limit? So the aggregate amount of deposit outstanding has exceeded that limit or not, which is specified by that credit rating agency. So credit rating in force, and that acceptance of deposit beyond limit. Okay, that is something auditor has to report. Okay, then again, any violation with respect to any of the provision of these norms, okay, violated restriction on acceptance of deposit that is provided in the direction or not. So any violation with respect to that. Then comes whether there is a default in paying to its depositor. So auditor has to report about the defaults on the principal amount or in the interest or principal that has become due. Okay, so default on payment, default of payment rather, by company on these deposits. Then the next part comes is very important, that we have discussed on the prudential norms, whether the company has complied with the prudential norms on income recognition, accounting standards, asset classification, provision for the bad debts and the doubtful debts, and concentration of investment and the credit specified in the directions. So prudential norms or prudential regulations not only specify the asset classification or provisioning for the bad debt, but they also specify about accounting standards. They also specify about the income recognition. Okay, so prudential norms or prudential regulations specify various things that we have seen. Okay, now whether the NBFC has complied with that or not, you can only report on that matter when you know that whether what are the prudential norms. So if you have to report on the prudential norms, then you need to know what are the prudential norms. Then only you will be able to report on that. Okay. So reporting on prudential norms. Some students might have a doubt whether, sir, it's a prudential norms or prudential regulations. Both are same. It is used interchangeably because earlier they were known as a prudential norms. Somewhere it is reported as a prudential regulations, but usually they are known as a prudential norms, not regulations. They are norms basically specified in the master direction, but sometimes it is used interchangeably, so perfectly fine. Okay, now there is a requirement of maintaining liquid assets in the RBI Act. There is a requirement of maintaining liquid assets in the RBI Act. Okay, now there is a specific section 45 IB, basically, that they need to maintain liquid assets, a percentage of particular of total asset. They are to maintain the liquid asset. Okay, and whether that has been complied or not, that is auditor has to report. So basically, again, that liquid asset requirement is based on the classification. Base layer has something different, middle layer has something different, upper and top layer has something different. But there are requirements, and whether those are met or not, that is something auditor has to report. For example, if I give you an example with respect to the you can say middle layer. Okay, now what middle layer requirement with respect to the liquidity is that middle layer has to capital first of all the what is the their total assets based on the criteria which is given. After that they have to calculate, there's a complex formula given that they have to calculate on the liquidity requirement. What is the liquidity requirement for them? And there's a percentage then given that they have to apply to that particular calculated amount in order to derive what is the liquidity coverage ratio they need to maintain basically. Now this is the calculation given that how liquidity coverage ratio is given is required to be maintained. Okay, so a detailed, again over there also there is a timeline given, like minimum 50% earlier it was there, then it goes to the 100%, more than 10,000, less than 10,000. Detailed, things are given in that. Okay, so there is a classification in which with high quality liquid asset, then total net cash outflow. There are lot many things given. If you want to read, you can read. Okay, but a complex formula is there based on which this is calculated, and then auditor has to report basically whether that has been maintained or not. And banks have to report that in NBS 3. Okay, so first of all, whether that has been reported by the non-banking financial companies in NBS 3 or not. If yes, then it has been calculated appropriately or not. So liquid asset requirements as specified in 45 IB. IB says you need to maintain as per the specified number. Specified number again goes to the your scale-based regulation. Okay, so I would write here is liquid asset requirement, or when you will refer the scale-based regulation, it is known as liquidity coverage ratio. Okay, then there are other requirements, basically whether the DNBS 01 was deposited or being filed with the bank RBI or not. Okay, whether the company or whether the NBFC has submitted all their quarterly returns to the Reserve Bank or not. So these are with respect to the return filing requirements, whether return filing is done or not. Okay, and then appointments of agent with respect to collection of deposits or opening up new branches. So there is a specific requirement in the companies, the NBFC acceptance of public deposit directions. Okay, over there they have to either when they are appointing the agent, when they are opening the branches, when they are closing the branches, they have to report to the bank, they have to comply with certain regulations, certain directions, and on the basis of that whether the NBFC has done that or not, that is required to be reported. So opening of branch or appointment of agent. Okay, that was your B category. Okay, now this was A and B category, but these are the two major categories which are there. Apart from that, there is a C category also. Okay, now C category is quite small. It's there basically for the NBFC not accepting public deposits. Okay, not accepting public deposits. Basically, it is kind of apart from the general, it is applicable to NBFCs not accepting public deposits, means other NBFCs, and it is pretty much straightforward. What is the category C says that category C is only talks about whether the company has, actually the company should not accept any public deposit. That's why they are coming into the category 3, and whether they have complied with the norms with respect to non-acceptance, means whether they have passed a resolution for not acceptance of any public deposit, whether they have accepted any public deposit because they were not supposed to do that, whether they have complied with the prudential norms that we have seen, okay, whether they have the capital adequacy ratio and whether they have furnished the annual statements of the risk assessed ratios. That is the requirement for the category C. So resolution for non-acceptance of deposit, okay, then whether accepted deposit because they were not supposed to do that, prudential norms, annual return, this is capital adequacy ratio return, and then you have an annual return, again return requirements. That's it. And yeah, there is one more requirement with respect to the classification of MFI. Reason because MFI has a separate set of regulations apart from scale-based regulation. This is a specific class of NBFC. So that's why classification of MFI is required to be done. So there is a separate regulation for the MFI, directions for the MFI. So this was the ABC classification, and B for the deposit, A for the all in general, and C specifically for non-deposit, because just to make sure they are not accepting deposits. Okay. Now, whenever there is a breach, when there is a unfavorable or qualified statement, auditor has to report the reason for the qualified statements. Okay. So auditor has to report what is the qualified thing here, matter over here, why it is qualification, the reason in detail behind that is required to be reported. And then whatever qualifications are there, summarize that with respect to the chapter 3 of RBI Act, that is again section 45 IA, section 45 IB, whether it is acceptance of the public deposit. This is nothing but category 1, category A. This is nothing but category B. Qualifications with respect to category B things, or qualification with respect to SBR scale-based regulation. If there is any non-compliance with any of the things, prepare a summary report of the non-compliance of the unfavorable and qualified remarks. Okay, and then send it to the RBI, to the Department of Non-Banking Supervisory of the RBI. Simple. That is the requirement of the auditor for the unfavorable part. So remember, in the start we discussed that okay, auditor gives to company to RBI. That is one for this COR related certificate of registration. But if any qualification is there, then RBI directly to RBI for qualifications and adverse remark. Clear? Any doubt? Yes, Kirti. Stock exchanges can be called an NBFC, but they have a separate registration requirement under SEBI regulations. That's why they are not required to get themselves registered under RBI Act, or these regulations are not applicable because they are primarily governed by SEBI. Now, if you see the 50-50 principal business criteria, they have their financial asset as they have mostly their financial assets. Okay, not even 100% is a financial asset, and their income is also from those financial assets. So 50-50 criteria is being met. Okay, and they are a specific class also of the NBFC. That's why they are a special type of NBFC which is not governed by RBI but by SEBI. Any doubt, guys? Any doubt with respect to any of the point? Okay. Now, I think there was one doubt with respect to the Nidhi company and NBFC. See, Nidhi company is also an NBFC. It is not. It is not such like that. Nidhi company is not an NBFC. It's an NBFC. But being an NBFC, it is governed by directly central government and Ministry of Corporate Affairs. It is not under the purview of RBI, because Nidhi company is a specific type of company. Okay, they have a different, basically what you say, requirements. They are for a specific business. Okay, so that's why they are not governed by basically the RBI regulations. Primarily, they are governed by the Companies Act and central government. So Nidhi Company Rules 2014, which are there, and there are amendments to that also, that govern them compared to the RBI. Okay. So yes, Nidhi companies are also a category of NBFC, but they are specific category. Okay, and that's it. They are required to be registered under RBI Act. Oh, sorry, not RBI Act, but Companies Act. Any doubts? Any other doubts apart from this? No doubts? Okay, no issues. What I need from you guys is, in the next session, I will take up the remaining portion of this particular unit 2. Okay, we need to discuss some of the auditing procedures and fraud related things over here, and then we will go to the audit of banks. So I would request everyone to read the rest of the portion of this chapter and the audit of banks. Okay. Yes, there is one doubt. Yes, Kirti. Stock exchanges are also incorporated under Companies Act. See, Companies Act talks about the structure of a entity. Okay, when I talk about Companies Act, they are primarily governing the structure of the entity. When I talk about RBI Act, when I talk about SEBI, they govern the operating aspects of the company. The you can say business trading that they are doing, or not trading, basically I would say the business or the operations they are doing, that they govern. Okay, so whether it's a Nidhi company, whether it's a stock exchange, whether it's a housing finance company, okay, even the other, microfinance, or different kind of NBFCs which are exempt, even the insurance companies, they are registered in the Companies Act, because that is an act to govern the structure, not the operations. So that's why they are incorporated under Companies Act, but they are governed by the SEBI. I hope it is clear now. Okay, thank you. So guys, in the next section, I would request everyone, to read the rest of the topic and chapter B, that audit of banks unit, so that we can start that and we will discuss the remaining part of this particular chapter. Please come up with your doubts, whatever doubts you have, okay, so that you can get a clarity of this particular chapter. Do provide your feedback. Do provide your feedback, because it is very important for me to understand whether you are liking the lectures, whether you are finding these lectures fruitful for you guys, whether you are getting the things or not. So please provide your feedback. That is very, very important me for to understand that it should be carried in this way, or you want any change. Okay, so I would say thank you guys. Thank you for participating in the session. Sorry for the sound glitch in between that happened. Okay, but thank you for participating in the session. I will see you in the next session. Yes, sir.